Hello, everyone. I'm Richard Parkinson, Chair of the Treasury Today Group. Welcome to this webinar looking at sustainable strategies through a Treasury lens. The 2020 Treasury Today Global Sustainability Study has told us that sustainability is now reflected in many organizations' core values. But we know also from our findings that the practical implementation of sustainability in corporate finance and Treasury still has quite a way to go. And it's true both in terms of the solutions being offered, but also the speed at which they're being taken up. Today, in the company of BNP Paribas' Hervé Doutet, who's Chief Sustainability Officer for the Americas, and Alberto Ayerza, Managing Director, Global Trade Solutions, and Indra Kish, Director, Senior Liquidity Advisor, we're going to be exploring how sustainability has risen up the Treasury agenda, the instruments that are available now. I mean, is there more to it than just green bonds? And what innovations are in the pipeline? On the way, we'll be offering some practical advice on how companies can leverage these solutions. Most importantly, the aim of the webinar is to arm you treasurers with knowledge and understanding, not just to get the most from the products and services, but also to help others within your organizations see the benefits of adopting and practicing a sustainable strategy. Our 2020 survey results show that 61% reflect sustainability in their organization's core values, and 81% said their company has appointed a sustainability champion. And we know, too, that 47% include CSR and ESG metrics in their annual reports. I mean, clearly these are encouraging figures, but this also means there's some more work to do. The world's changing, and expectations are high that the corporate community takes an active role in improving all our futures. Treasurers have the opportunity now to play a leading role in how their organizations respond to the call of sustainability. And for those of you still wondering what sustainability means in operational terms or feel a bit uncertain where to start, I hope we'll be offering you some suggestions as to how you can become a key influencer. So from leveraging supply chain relationships to drafting internal policies on working capital and investments, and including the impact that COVID-19 can have on our sustainability policies, we're going to be discussing what matters from a Treasury point of view. So let's turn to our panel. And I thought we should really start out by finding out where sustainability sits within BNP Paribas' agenda. And obviously the man to ask really is Hervé, because Hervé is as Chief Sustainability Officer. Do tell me, how important would you say sustainability is at BNP Paribas? And how have you changed and refocused your business model and objectives as a result of this?
Thank you. Good morning, Richard, and good morning, everyone. So obviously, I won't surprise you by saying that sustainability is truly at the core of what we do and what we've been doing, even though we're not perfect and we can do it better. But it proceeds from the conviction that we have that we can have an impact through finance. And this has particularly guided product development over the last 15 years, I would say, in asset management, and more recently over the last 7 years in investment banking. But first, to answer your questions, I would just spotlight 4 elements. The first one is we've been walking the talk for quite a while with at least 2 decades of fairly restrictive policies with regard to who we finance and who we choose not to finance. Just to give a couple of examples, recently the latest iteration of our coal policy is a clear exit timeline of financing power utilities that would still have one single coal plant in any OECD country by 2030. or in the rest of the world by 2040. So that's one example of how, before we talk about sustainable products, sustainable finance, how first we try to keep our house in order. 3-4 years ago, we also have been the first and probably almost rare bank today to also no longer finance companies that have their primary business in exploration, production, transportation, trading or marketing of oil and gas coming from shale. And maybe last example, we less than a year ago published our first biodiversity policy focusing on oceans. So the first stone upon which we build a house has been to be fairly restrictive in what we finance. We try to accompany clients in their transitions, but for those who clearly have a strategy that's not moving towards a net zero carbon by 2050, we have decided to stay away. The second step is to set goals. Back shortly after the SDGs were enacted by the United Nations, we set for ourselves a goal to have at least 185 billion euros of on-balance sheet financing directly contributing to the fulfillment of the SDGs. We've almost, we were at 180 billion at the end of last year. As well, one thing we watch very carefully is the energy mix we finance. Just to give an illustration, the world energy mix roughly has about 39% of electricity coming from coal. In our portfolio, for the first time, we've gone under 20%. And of course, we have a goal to be at an absolute zero by 2040 on coal-generated electricity and stepping up on financing renewables. So walking the talk, setting goals. The third element is measuring. We have committed to align our portfolio to a well below 2-degree scenario. So we are part of the UN Principle Responsible Banking Coalition, and more specifically the collective commitment towards climate action, to really do a lot of work on measuring the direction of our portfolios and tilting the balance. And last element, so walking the talk, setting goals, measuring and aligning portfolios. The last thing is compensation. We have a policy where we have 8 sustainability KPIs that are closely monitored and that directly affect 20% of the floating remuneration of our top 6,500 officers in the bank. So this is the way we at BNP Paribas try to embed sustainability before we talk about all the fun stuff, which are the products we collectively create for our clients.
Thank you very much. That's a good moment for us to really switch and talk really a bit more about how ESG is becoming a top priority for treasurers. Alberto and Indra, perhaps you could take us through some of that.
Absolutely, Richard. Thank you very much, and thank you everybody for joining today. So the first thing that comes to mind when I saw this question, how is ESG becoming a top priority for treasurers? Well, is it really? I'd like to challenge that premise a little bit here. We've seen mixed signals, I would say, amongst our clients and amongst different sectors. And I think the result of the survey kind of back that up. 88% of respondents do mention that ESG has visibility at board level. Yet it is our opinion, or my opinion, that visibility does not trickle down. Those shareholder and stakeholder clear ESG objectives don't trickle down as they should, or as much as we do like, down to the Treasury departments. In the past, we've seen ESG goals from companies driven by client needs and actual sales. forestry, protein sectors have been pretty good at traceability in the past, driven by the needs of their clients. If you don't give me some traceability, if you don't give me certain certification, I'm not buying from you. I think that has reached further larger audiences. But coming back to the priority matter, we believe that setting clear KPIs across an organization, including Treasury, is going to be crucial going forward for ESG goals to really be embedded in a company's culture. Another result of the study says that less than 10% of the respondents spend less than 10% of their time in ESG matters. That's not surprising. These days, Treasury departments are really thin on people, and they have a lot to do. But that also shows that there needs to be, in my opinion, a little bit more involvement there. Also, regarding Treasury departments, I think there needs to be a change of mindset. Efficiency and lowering costs are a lot of the times the primary objectives of a lot of our Treasury counterparts at our clients. But when we introduce ESG goals, sustainability, I think that change of mindset should shift away from the short-term monetary benefit and maybe make a little bit more emphasis on the long-term overall benefits that the company is looking for. So that's it on my side on this particular point. Indra, you want to walk us through what you found?
Yeah, sure. Thanks so much, Alberto, and good morning, everyone, or good afternoon for some of you. Alberto, you had said something interesting there. First of all, you had said that the ESG, this is all going to become a priority going forward, but it's been challenging for it to trickle down to the Treasury level. Why not let it trickle up, right? So you, as a treasurer, your Treasury team, start to now think about ESG as a priority. There's sustainability-linked financing, and there's short-term investment solutions that are out there. The world is changing, as we all know it, very quickly. We're in this COVID-19 environment, and every company now has an opportunity to improve its footprint. Historically, I think it's been more, based on these numbers on this slide, you've seen, less than 10% have had time to think about this. But I think it's been somewhat sector-based historically, where you'd see maybe forestry or energy companies focused on sustainability more so than other companies. But now this is going to spread across the board. So this is an opportunity for Treasury teams to lead the change. In other words, it's an opportunity to educate your management and your board on the products that are available within the Treasury space that are going to help meet the corporation's overall KPIs and goals. And therefore, I think it is becoming a top priority, and you're not going to see it otherwise go forward. And that's about it. Richard, I'll turn back to you.
Well, I think maybe we should bring Hervé in on this as well, because Hervé, what have you seen are the most common, or what are the innovative solutions that you've seen BNP Paribas involved with?
Sure. So broadly speaking, I would say there are two generations of products, just to keep things simple. So about 6-7 years ago, the big discovery in the banking space, I would say in the Treasury space, was that you could attract different investors or additional capital or additional interest by starting labeling what you finance. So that first category of products is what I would call the labeled use of proceeds. So it's the famous green bond, but with it came, a variety of cousins, from social bond, sustainable bond, pandemic bond, rhino bond, gender bond, COVID-19 response bond now, or virus control bond. So that was the first discovery. As soon as you put a label, we uncovered pockets of money that traditional investors were not reaching out to, sometimes at even existing investors, be they BlackRock or PIMCO or many others, because you have green bond funds, sustainable funds, and many others with a dedicated focus. And so by labeling your bonds, instead of having one order from a house, you may have 3 orders. Then the second generation of products, which came truly 4 years ago, actually, first in the supply chain area, is what I would call sustainability-linked product, where basically the whole idea is the interest rate on the product moves up or down in relation to the future achievement of some sustainability performance targets. So we no longer look at what you're doing with the funds. These products are general purpose corporate funding, but instead we're looking at the impact. We're looking at the future outcome, and the interest rate will move up or down. So these are the 2 categories of products, and around that, we've really worked out hard to push the limits across all dimensions. So pushing the limits across asset classes. As I mentioned, the sustainability-linked product started in supply chain, but then they moved into the revolving credit facility market, the term loan market, then the bond market, and lastly in the derivative market, where we have interest rate and FX forward swaps with that same mechanism, where the interest rate will move up or down in relation to your CO2 emission reduction or whatever. Pushing the limits across issuers, corporates have participated, financial institutionals, as well supranationals and sovereigns. Pushing the limits around themes, it started with green, then we went into more social themes, biodiversity themes. We did forest bonds, COVID-19 response bonds, as I mentioned earlier. And lastly, just to conclude, pushing the limits also in terms of the capital structures we tackle, and that's more the space of blended finance. But just to try to cover the global picture, these are the various dimensions we've been working around. So labels and sustainability linked in terms of products categories, and then pushing the limits across asset classes, issuers, thematics.
We've actually had a question come in on this. Is there? You're really talking about how interest rates might change depending on the performance, but are the lenders and investors happy with those sorts of products?
I'm happy to answer that. Yes, one has to understand 2 things. As lenders, as investors, we have a vested interest in having the people to which we extend money becoming more sustainable. We all have in our portfolios embedded systemic risks, which currently are untackled for the most part by public policy, untackled for the most part when it comes to sustainability by regulatory bodies. And quite frankly, modern portfolio theory cannot hedge that. There's not enough gold in the world and doomsday stocks to buy to hedge our portfolios against systemic risk. So the only way we can hedge that systemic risk is by engaging the parties we are lending money to, so whether they're equity or bond or whatever, and with them try to get them to accelerate their transition journey, because that's what will make our portfolio more resilient. So we view it as a risk. Like any risk, it has a price, and therefore the rate at which we lend money should technically be higher or lower in relation to this looming longer-term sustainability risk. Granted that it's a portfolio risk, it's not necessarily directly one-to-one to the person to whom we lend. So globally, that's the idea behind that. Actually, it's really, at the end of the day, sustainability is a financial risk, it's a credit risk, it's a portfolio risk, and it has a price.
Interesting. Okay, that's very interesting. Now, Alberto, let me turn to you because you're more involved with global trade. I mean, we've really been talking there about some of the capital markets products and green bonds and the sustainability-linked liquidity solutions. But what's next? I mean, can companies leverage trade and supply chain finance in some way to assist in ESG goals?
Thank you, Richard. Yeah, absolutely. Indeed, green bonds and sustainability-linked loans and pretty much most of the first generation and some of the second generation solutions that Hervé was mentioning have been more famous, more frequently used, and as such, I would say more common to our colleagues in treasury departments over the last years. But I strongly believe that there's a whole set of solutions that need to be still worked on and developed on the trade and on the supply chain side. As a reference, there's an Ernst & Young report from some time back, but it's still very applicable, and that report states that 80% of greenhouse gas emissions in most consumer goods companies are in their supply chain. So clearly, when we look at a statement like that, we kind of feel that there is room for ESG focus and sustainability focus on the supply chain. As a result of that, I think a lot of companies and corporations are implementing measures and taking public commitments around that, like committing to buy certified raw materials through some independent sustainability certification programs. They're putting compulsory code of conduct for their suppliers. Sometimes those code of conduct not apply only to their suppliers, but their suppliers as well. So it goes like 2 levels up the value chain. And of course, developing their capabilities to audit, evaluate, train, and support their suppliers to reach their own company's sustainability goals. So definitely there's some work that we can do and work with our clients to develop there. If we come back a bit to the survey, 52% of respondents have mentioned that they have metrics related to how they select and manage supply chain. If this survey was only responded by supply chain people, then I would be worried. But given that this is respondents on treasury departments, I think this is very, very encouraging statement. Just to make another note, McKinsey also mentions a 3-step approach to making supply chain more sustainable, and the first one is to identify critical issues across the supply chain for both natural and human resources. I think maybe that's not the place where treasury would come in, but then as those issues get linked to a more global sustainability agenda, and we start looking at solutions around that, I think treasury departments definitely need to be a part of that solution. We have been working on supply chain for a while now, sustainability related or not, and what we see is that every time we touch inventory from our clients or accounts payable or accounts receivable, it is not only treasury departments that are involved here, but procurement and salespeople that need to be involved as well. So as we talk and as we go into the solutions around this, be it monetary, be it commercial, be it by technology or knowledge sharing or transfer, I think the involvement of of treasury becomes more and more crucial as the companies try to find solutions around their ESG goals. And just to wrap this, we've also seen regarding COVID, right? I mean, a lot has been talked these days. The disruption caused by COVID has put an emphasis on supply chain resiliency. That resiliency is pretty much making sure that clients are able to, complete their production process and achieve their production goals. Given that a lot of these processes will need to be redefined after COVID, I think it's a great opportunity to incorporate the responsibility and sustainability concepts into that redefinition, so that not only supply chains can become more resilient, but also more responsible. And I think this is also a place where Treasury departments can take a big say on that.
Okay, so
sorry if I went a little too long.
No, not at all. There's obviously quite a few things going on in that area. I think we ought to probably turn to liquidity management and investment strategy now. Indra, perhaps you could tell us a bit more about what treasurers should be considering when integrating ESG goals into the areas of liquidity management and investment strategy.
Sure, Richard, I'd be happy to do that. My recommendation would be, my first recommendation would be for treasurers to review their investment policies of their corporations. As we know, we've all been thinly staffed. I think everybody dusted off their investment policies at the time when rates started to go up. Now they've come back down. But I think it's time to dust them off again, because I suspect that most of you on this call have not considered ESG language to include in your investment policy. So this is something you might want to think about. And I've put this slide up in case you want to take a picture of it. There's a lot of verbiage here. But in any case, just to give you an example, I think you could say something like, consistent with achieving the investment priorities and goals set forth herein, the policy will be implemented with a framework predicated on incorporating ESG or impact and solutions-based investments. Or you could say something like, the company is going to make earnest attempts to incorporate ESG-related investments in its practice, while ensuring that these investments comply with the top priorities of safety and preservation of principle, as we all know is the most important thing for a treasurer, followed by maintaining liquidity, and lastly, generating yields. So these are ways you can, include some broad language. It's key to be broad and flexible. Why? Richard had indicated or mentioned at the beginning of this webinar, he talked about innovation, and there's innovation of new products. Products are going to be rolled out on a go-forward basis. So as these investment products come out, you want to make sure you have that flexibility within your policy. Lastly, I also had put some language in here on the right. This is really just for to think about for any RFPs or RFIs you have referring to third-party asset managers. If you're in that great position to have excess cash that you're outsourcing to a third-party asset manager, you may want to integrate language to evaluate the fund managers on how well they incorporate ESG into their research, their analysis, and decision-making. Again, remember, the investment policy is approved by your board. So again, this is another chance for you to have a seat at the table, to work ESG language into the treasurer's role. And lastly, I should have mentioned at the beginning, what you do want to make sure not to forget is to make sure that anything you do put into a policy is aligned with what KPIs and goals are provided at the very top of your firm for sustainability.
Okay, that's interesting, and some of that wording you've come up with there could be very useful. Okay, there's really quite a lot going on there, but it seems to me that there are probably some additional opportunities for treasurers to further contribute to their organisation's ESG strategy that we may not have explored in detail so far. So perhaps I could ask maybe Alberto and Indra to give me or give us some examples of potential solutions.
Sure. And Alberto, if you don't mind, I'm going to take this first as we go on to the next slide. But they're very, this is just to exhibit to you some of the things that are out there. So green deposits. What is a green deposit? This is something that has historically been a deposit that comes into a bank to help support a renewable energy project, right? So that's theoretically what it has been. But now I would say green deposits is a word that's used as more of a generic term for supporting ESG projects in general. So it doesn't have to necessarily be the environmental side. It could be the social or governance side as well. There are requirements for regulatory reporting around green deposits. The key with green deposits is that the financing side needs to grow in order for, so that's the asset side, right, for the liability or deposit side to grow within these banks. But we're seeing that now because we're certainly seeing some significant growth in 2020. So stay tuned. I think you're going to see more green deposits being rolled out. We've done one that's out in the public for JetBlue, and there's some other banks that have named some of the deposits that they've done as well. There are three forms that they come in. I've seen them in a time deposit. I've seen green deposits taken in a bank account and also in a certificate of deposit. So those are things to think about. And certainly, these kind of deposits are something you're familiar with in general outside of the green factor. There's also sustainability-linked deposits. I would say these, there's a couple of providers that are out there. They may, for example, link a deposit to the United Nations, the SDGs, the Sustainability Development Goals there. Money market funds, all your major money market funds that are out there, whether it be a BlackRock, a State Street, a Fidelity, and whatnot, all have, ESG money market and mutual funds that are available. And on the money market fund, and I say this because that's more applicable for the treasurers who are managing capital preservation, they tend to be prime funds. Well, they have to be prime funds versus a government fund. Tailor-made solutions. So let's think, for example, about a structured deposit that might be linked to an index, right? So if you can take a little more risk, you might want to think about that. Or you can outsource a third-party to a third-party asset manager, separately managed account. And in your investment management agreement, you can certainly, put in specific guidelines related to ESG. Or again, as I mentioned in my prior comment, you can, interview the asset manager to make sure that they have ESG practices within their firm already. Alberto, I'm going to hand it off to you now. What do you think? See on your side.
Yeah, thank you, Indra. That's very interesting. I think on the trade and supply chain side, we're starting to gain ground here, and most importantly, I think we need to work with our clients to develop these products. We have some ideas. We change ideas from one sector to another, try to apply things we learn in one sector to others. But of course, down the road, everything will depend on working with our clients in determining those products as they are the ones that really know their supply chain and what the critical points are there. Just to go quickly, first I want to mention, this is very timely, just a case study. Our colleagues in Spain earlier in May this year, so this is pretty recently put in place a 600 million euro sustainability-linked syndicated guarantee facility. It's very interesting transaction. The legal documentation has some sustainability objectives linked into that, sustainability ratings linked into that are measured by a third party, and depending on the performance or not of those sustainability or the achievement of those sustainability objectives, there is a premium to be paid by the bank if client achieves those. And the interesting here, the dual environmental and social sustainability purpose that I mentioned there is because the payment of that premium doesn't go to a company, but it goes to a cancer research project in Spain. So this is just one example of how companies are looking and changing their transactions to achieve their ESG goals or enhance their sustainability profiles. Here's another couple of products. So we talked about sustainability linked guarantee. We've also worked with utility companies in setting up sustainability linked pricing, and that pricing varies depending on their clean energy generation or purchase. So we've been looking into that in some of our standby LC facilities in the US. Sustainable supplier finance, I think that's maybe what has made a little bit more inroads, and that's basically applying an external sustainability rating to each supplier, and then suppliers might approach the bank to discount receivables and obtain financing. The cost of such financing may vary depending how good or bad that sustainability rating is. We're exploring what we call sustainable shipment letters of credit. That is not rocket science. It's just using traditional trade finance products like documentary letters of credit, MT700s, to contain evidence that the procurement of certain goods has certain certification, third-party certification. We can do that in palm oil and other agricultural commodities where the extraction of that commodity is challenged in some countries. And finally, we've started to explore sustainable what we call sustainable receivable financing, which is nothing more than supporting our clients in their sale of green goods. Green goods being capital goods that are friendlier to the environment and that could also generate cost savings for their clients buying that, but that do require some capital investment. And so by granting those longer payment terms, we're facilitating the transition to cleaner and more cost-saving solutions. Of course, again, these are the items where we are focusing. There might be a lot more out there and a lot more that we are ready to discuss and work with our clients to implement. As Hervé mentioned, the bank is very, very focused on this, and we are more than eager to expand our sustainability offering on the trade side.
Okay, I mean that's very interesting. You've mentioned some quite interesting things there, but maybe I can ask Hervé to give us a take on this, and that is that, Hervé, we've obviously got the COVID-19 crisis with us at the moment. And it seems to me that could well set us back with regard to some of these ESG goals that we're trying to move towards. What is your opinion on that?
My opinion is absolutely not. We are currently set back. We have been in total hibernation at home for the last 3 months. Most of us have barely taken the subway, be it a plane, and that's what I call being set back. And it's the present that has set us back. So if anything, this COVID-19 crisis has given us glimpses into what the future may hold. And I see 3 lessons out of it as far as it relates to sustainability, and they're all positive for the sustainability agenda, and therefore all positive for the private sector to embrace this agenda, to raise the bar for this agenda, to accelerate this agenda. And for it, you need finance, hence sustainable finance. So those three lessons are as follows. The first one is, it's obvious, but this crisis underscores the future we want and the need for long-term perspectives. So I think as we slowly resume to some form of normalcy, I think we collectively as the civil society, but also as the private sector, really have a renewed understanding of a long-term focus. The second is this crisis stresses what systemic risk is about. Here we're talking about a pandemic. We know climate change is also another form of systemic risk. We may think that systemic risk will affect only the unlucky ones, so those who will be sick or sadly will lose members among their close families for pandemics, or sadly for those who have a house by the sea affected by sea level rise. But actually what we realize is that whether it's pandemics or climate change, those systemic risks are first and foremost socio-economic risks that in this case did affect 4.5 billion people, which is much, much more than the people who were sick. It's about job losses. It's about small and medium enterprises fighting for bankruptcy, and it's highly disruptive. Thirdly, this crisis highlights the need for preparedness. Here we have an example of being unprepared. We also have an example of what I would call an abrupt decarbonization pathway can be. We know we need to decarbonize in the future. Here we've done it temporarily in a disorderly fashion where you have negative oil prices, you have planes grounded at airports, and it's really not the way to do it. Millions of people in those industries are suffering. So it's better to spend the next 10 or 20 years really getting our own house in order and transitioning those sectors that need to be transition, but do it in an orderly way that's just and fair and good for all. So I think this crisis, with all the negatives it has brought to us, has, however, a green lining to it, and it's the need, the renewed understanding of that we need to be prepared and that we need to be fast to create the future we want.
Oh well, I mean that's a lot more positive than I was expecting. Okay, there's actually there is a question that's come in that in a way is quite a good way to wrap this up. It's really a question about, as you've put on this slide here, continuing the dialogue. The question is really, where do we get more information? Because you've referred to some really quite interesting solutions here today, which I think for some people will be the first time they've heard about them. And obviously, in the time available, you've only been able to give a very quick summary. But where can we get more information on these sorts of deals? Not just the ones that you're doing, but also the deals that are being done in the market. How do we educate ourselves about what's available? Could you, some of the information must be in the public domain. Could you possibly respond to that question? I'm not quite sure which one of you to ask. So, any suggestions?
I can start. First of all, I mean, the obvious answer is talk to your bankers. But first of all, we see there's a lot around. We've reached this tipping point after 6 years of hard work, where now it's really in the public domain. We've been talking to treasurers, to CFOs over the last 6 years with varying degrees of receptivity. What I can say is that most we've spoken to through a 2-year journey have really embraced, at least intellectually, the ideas. Some have participated to use the financial solutions. But what we can say is over the last 12 months, I mean, it's front and center all around. It's not maybe, it may not be implemented, it may not be used, but I think now it's on the front mindset of I think any finance or treasury division. What I would say is that what's important to understand is that what we've created in finance is, I would say, a race to the top. Finance by itself is not solving the sustainability challenge, but what we've created is providing incentives to do the extra mile, showcasing the best in class, and that in turn is creating a race to the top among the various sectors that have been participating. And so treasurers can see within their own sectors what others are doing. The information is publicly available, and we can help them embark on the race as well. And the point is not to be first. The point is just to be ahead so that others come ahead of us. Because there's nothing we can solve on our own, but it's a collective challenge. And the point is to emulate and to outbest one another just for the sake of being overtaken on the next round.
Thank you. Unless anyone wants to add to that, I think that's a very good way to end the webinar. It only remains for me to say a big thank you for a very interesting webinar. We certainly went into some areas that I feel I just don't know enough about. I think I've got a bit of homework to do. Thank you very much for your time today, and thank you very much for giving us such useful information. That's the end of this webinar.
Thank you.
Thank you very much.
Bye-bye.
Bye now.